Welcome to this month's office hours, where we're discussing structuring charitable giving in a way that can benefit you too. I'm Amy Moody, Associate Wealth Advisor at Flagstone Financial Management, joined by Lead Advisor Dan Staus. We also welcome any financial related questions, which you can enter in the Q&A on the bottom of the toolbar. Flagstone Financial Management is a registered investment advisor. Information is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. We're glad to have you today. Dan, are you ready to get started?
Yeah, and I'll add a couple more comments to that disclosure, as much as I hate to do it, but we are going to discuss some kind of technical stuff today regarding the tax effects of various giving strategies, and there's also some things related to estate planning. So definitely consult an estate planning attorney if you're thinking about doing anything as a result of the discussion that we have here today. Yeah, just take that warning lightly or seriously rather, along with the consulting a tax advisor, because there's a lot of general stuff that I'm going to talk about, and it's really just for education. It might not actually apply to your circumstances for a lot of different reasons. So anyway, with that, I am going to share my screen here. And we're going to go over 4 different charitable giving strategies. And these are 4 common ones. There are plenty more, but these are some of the more popular ones that we see our clients here at Flagstone take advantage of. So strategy 1, qualified charitable distributions, or QCDs. So that just means you're taking money directly from your IRA, your traditional IRA, and you're giving it to charity, as opposed to having that money go to your checking account first and then go to a charity. So if you have a required minimum distribution, then whatever you do in a qualified charitable distribution will kind of satisfy a portion of that RMD. You have to be 70 and a half at the time of the gift. So RMDs don't start till you're 72, but you can do this starting when you're 70 and a half. The maximum you can do is $100,000 per year. And the tax benefit is that this money just never, a QCD never hits your income. So instead of taking $5,000 from your IRA and having to go to your account, and then there's $5,000 of income on your tax return, it just completely bypasses you, goes to the charity, doesn't show up as income. So the bottom line is, if you're 70 and a half years old or older, and you already give the charity using your checking account, consider using your traditional IRA instead in the form of a QCD. So let's go over an example here. So Phil, a philanthropic fella, is 75 years old. He has a $10,000 required minimum distribution from his traditional IRA. He typically gives away $4,000 to his church. He pays 24% in federal income taxes, or he's in the 24% bracket, and then 6.85% state income tax bracket. He takes a standard deduction. So typically what people do is they'll take their RMD, have it go to their checking account, and they'll write a check to their charity. And, you know, maybe it's not a $4,000 check that people typically write to their church. Maybe they give a certain amount every month, and over the course of the year, it adds up to $4,000. Well, if Phil does that, like most people do, he's going to have to pay tax on that RMD, and that'll be about $3,085. He doesn't get any tax deduction for the $4,000 contribution that he gave to his church because he takes the standard deduction. Well, alternatively, he could have us, his financial advisor, we could send him $6,000 to his checking account because that's what he needs to live. And then we would also send him or excuse me, we would also send $4,000 directly to the church. Well, then he just has to pay tax on the $6,000, so he saved about $1,234 in tax. So that's just an example. That is kind of overly simplified, but it shows you that it's just a mechanism, like a pretty simple, hey, don't send money to me, send it to the charity. That could save you some money in your taxes. Strategy number 2, gifting appreciated securities. So this is just giving away appreciated securities, or also known as investments or assets, in kind to nonprofit organizations. So let's say you bought something for $3,000 and now it's worth $4,000. Well, that'd be an appreciated security, and you can give that away in kind before, as opposed to selling it and then giving away the cash. So you get credit for the charitable contribution equal to the market value of the security. You avoid paying tax on the growth that has happened on that security. So if you own appreciated assets within a non-retirement account, so I'm not talking about IRAs here, then you can consider donating those appreciated securities in kind instead of donating cash, and then use your cash to repurchase whatever you just donated. So here's the example. Hopefully this makes it a little more easy to understand. All right, so someone bought shares of XYZ stock for $5,000. Now those shares of XYZ stock are worth $50,000. So option 1 is you could sell the stock and then donate the after-tax proceeds. And option number 2 is you could just contribute those shares of stock directly to charity. And this example is Schwab Charitable. They have donor advised funds. Schwab does. So, but that it doesn't need to be Schwab Charitable. They just created this graphic. Anyway, so option number 1, you sell the stock and donate the proceeds. Well, you have to pay tax on that gain. So that $45,000 of growth that has happened, in this example, someone pays 15% federal tax on that. And then there might also be state tax due on top of that. This is just showing the federal. And then, so that left over, there's $43,250. And then the person donates that $43,000, they get tax savings of $3,630. So option number 2 is they contribute the $50,000 of XYZ stock directly to charity. They do not owe any long-term capital gains tax. That's one of the huge benefits of donating appreciated securities. And then they also are able to donate the full $50,000. So they get a larger charitable deduction. So that tax savings ends up being $12,000, which is $8,370 more than the previous example. Then what this person could do is that they could go repurchase those same shares of XYZ stock using cash. And then when everything's said and done, they still own $50,000 of XYZ stock. They got their charitable contribution. They were able to donate more. They paid less in taxes. So it's like a win-win for the charity and for the person. The loser in that situation is the IRS. All right, strategy number 3, donor advised funds. Donor advised funds are, it's really an account type. It's like an investment account type. And it's like kind of a miniature family foundation. You contribute cash or securities to a donor advised fund. You get the charitable deduction in that year that you make the contribution. And then you send money, or send grants, they're called, from the donor advised fund to charities whenever you choose. So you could do that the same year that you put money into that account, or you could do it 10 years later. It doesn't matter. The tax advantage is that because you get the charitable contribution in that year, then you can do this lumping strategy. There's a lot of words that people use for it. I have down here lump, clump, stack, bunch, or pre-fund, several years worth. So let's say you give $5,000 a year. Instead of giving $5,000 a year for the next 10 years, you could give $50,000 today. And then you get that big charitable deduction now. And then over the course of the next 10 years, you send money from your donor advised fund to the charities. So they still get their same amounts every year. So the bottom line, if you're charitably inclined, but you don't itemize, consider using a donor advised fund to lump several years worth of contributions into 1 year. You can itemize in that year and then take the standard in the future. I'm going through this super quickly. And so I realized that like, if you're watching this recording, you can hit pause, read the stuff that's on the screen, Google the heck out of what I'm talking about here. You can also let us know, but I'll show you an example here that might make it a little easier to understand the concept, even if you're not sure of the specifics. But so this was created on kitsis.com. This graphic was, and it represents someone who is a single person who typically takes the standard deduction. When this was created, the standard deduction was $12,000. And those orange bars represent how much they had in deductions over these 6 years. And you can see that in every year, those orange bars, they were below that standard deduction level. So they none of what they deducted, or none of those items actually helped them. I mean, they could have $0 in deductions and still get the standard deduction. So they really didn't have any tax benefit to any of those itemized things. So alternatively, this person could lump their charitable contributions in 2019 and 2023, give nothing in those other years. And then you see that the graphic in those years, that amount deductible over the standard deduction, that amount in brackets, that is additional itemizations that happened then in those 2 years because of this lumping strategy. So, in those 2 years, they got $18,000 worth of deductions. And in the other years, they still got to claim the standard. So it's only helpful. It's not like you're just paying less in tax 1 year to pay more in another year. It's truly lowering that tax bill in those years. But and you could do this directly to charity, but the reason people like donor advised funds for this is they can lump in certain years, but they can still kind of let that money drip out to their charities in other years when they're not getting that charitable deduction. All right, so strategy number 4 is simply just beneficiary designation. So this is where we kind of get into some estate planning stuff. So you would definitely want to talk to an estate planning attorney about these things. But here's what you need to know. So if you give away appreciated assets from a non-retirement account upon death, then whoever you give that to gets a step up in basis. So if I had paid $70,000 for something, it grew to $100,000. During my life, there's a $30,000 unrealized gain there that I'll eventually have to pay tax on if I sell it. But let's say I die and I give that money away to my niece. She inherits that $100,000 worth of stuff, and she gets a step up in basis from 70,000 to 100,000. And so she won't owe any tax on that $30,000 worth of growth. So it really is truly nobody pays that tax on that growth. Now, there's some talk about maybe that changing, but that's what the law is right now. So if you list the second bullet point here, if you list a charity as a beneficiary of a traditional IRA, they get that money tax-free. But if a person inherits money and they put it in an inherited IRA, if they inherit a IRA, I should say, and they choose to take that as a beneficiary or inherited IRA, they have to take out that money from that IRA over the course of 10 years and pay ordinary income tax on that amount. So when given the choice between inheriting a $500,000 traditional IRA or a $500,000 non-retirement account, I'd rather inherit the non-retirement account because I'm going to get a step up in basis and I won't owe income tax on that. There might be some inheritance tax, but no income tax. So let's show an example here. We've got generous Joe. Joe has a $500,000 traditional IRA and a $500,000 non-retirement account. That's it. That non-retirement account, his cost basis is $300,000, or in other words, he paid $300,000 for that, and it grew to $500,000. No other assets. He wants to give half of his money to his daughter when he dies, and half of his money to charity. Okay, so he's got a decision to make. Who does he list for beneficiaries on these two accounts? Well, in option number one, he could list his daughter as his beneficiary of the traditional IRA and the charity as beneficiary of the non-retirement account. Well, under that scenario, the charity gets their $500,000 tax-free, but the daughter has to pay income tax on that $500,000. I won't read word for word this example here, but I'll just skip to the bottom line here. That the daughter ends up paying $154,000 of income tax on that money. If he would have listed his daughter as the beneficiary of the non-retirement account, then she would have just had to pay the inheritance tax and would have saved $149,000 of tax. The charity could still inherit the traditional IRA and they still get that tax free. They don't care. But that's kind of the bottom line there, is that nearly $150,000 of tax savings there. So that's an overly simplified example because that person had the exact same amount of money in the two accounts. They wanted to give half to charity and half to one person. Pretty simple. That usually is not that easy. So again, you'd want to talk to an estate planning attorney before actually acting on something like that. But it's something to think about. Those are the big four that I had, but there's other strategies that people can employ. There's CRATs and CRUTs, which is types of trust: charitable remainder annuity trust and charitable remainder unit trust. Those are not very common anymore, but they still are out there. You can combine these couple of these different strategies that I talked about today. Oftentimes people use a donor advised fund and they fund that with non-retirement money that has appreciated. So they avoid the capital gains and they can lump contributions to charity in the same year. So that's really powerful. You can't do a QCD, the first thing I talked about, into a donor advised fund. That's a rule that's out there. Anyway, you can get more complex than what we talked about today, but those are kind of four big ones. So that's really all I had for the prepared remarks. But we can take some time to answer questions that people might have, whether it's about that or really any financial topic. So I'm curious if anything's come in.
We do. We have a couple questions, and I do want to say, Dan, though, thanks so much for that information. It's really great to partner with our clients and see the joy that they get out of charitable giving, because they enjoy benefiting the charities that they support. But it's also a joy for us to be able to partner and allow people to experience the advantages to structuring it in certain ways and seeing the outcome of that. So thank you.
Yeah. And I was going to mention, like, all these charitable giving strategies, like the technical side of it is all around like how to lower your tax bill, right? But is that why we give to charity? No, that's not why we give to charity. We give because we have some sort of cause that we want to support. There's some sort of meaning behind the organizations that we're giving to. We don't just give to get a tax savings. If we were just truly selfish about it and wanted to maximize our net worth, we wouldn't give anything away, right? We would be happy to pay. My net worth is going to be higher if I pay 50% tax on a dollar instead of giving away that dollar and only paying 20% tax. Like, it still hurts your net worth, but that's not why you give. There's there's purpose behind that. So I hope that people have some sort of motivation other than tax savings in their giving, I guess is what I'm trying to get at.
Well said. We do have a couple questions, mostly non-related to charitable giving, but
Okay.
let's have a go at these. The first question that we received says, I have a lot of employee stock options through my employer. Is this a good area to focus on?
Yeah, I mean, generally stock options through your employer are a pretty good benefit. There's various reasons why you'd want to take advantage of it. I mean, sometimes it's just free money. And sometimes there's planning opportunities around that on how to minimize taxes related to that. But generally, yeah, it's free money. There are other times, like if you have a stock purchase plan, you're buying stock at a discount. I'm considering that free money too, because like whatever the discount is, that's quote unquote free. So yeah, you want to make sure things don't get totally out of whack. Like if you're not contributing anything to your 401k and all you're doing is buying employee stock, and then you also have your salary coming from your employee, that just like your the risk that's just solely related to your employer being successful is pretty high. So you don't want to go too far that direction, but yeah, generally those are pretty good plans to take advantage of.
Perfect. Okay, thanks. And then how is our tax return relevant to how our investments are made?
Yeah, that's a good question too. So there's so much around investing that affects taxes. All the charitable giving the charitable giving strategies that I mentioned, we don't know how that's going to affect a client's taxes unless we are looking at a return. Part of a prudent investment strategy is rebalancing and maintaining the portfolio at a specific target. And so that involves buying and selling can sometimes generate taxes. Well, if we're not looking at a tax return, we don't know the effects of what we're doing. So yeah, it's really important for us to collect tax returns so that we can see what we're causing, I guess. Roth conversions is another deal, harvesting tax losses or gains. There's all sorts of things that we do as an investment manager that are going to affect taxes. So it's a good idea for us to know what's going on there.
All right. Well, that's it. So I want to say thank you for joining us, and we're glad to have you. We'll be in touch about next month's office hours, and have a great weekend.
Yeah. Thanks, everybody.